I get this all the time. Well, should I just do 5%? No, because if you do 5% on a stock that's $171 versus 5% on a stock that's $7, big difference in the risk. Huge, massive. Okay. These are Heikin-Ashi candles. The whole class is about Heikin-Ashi candles. The Heikin-Ashi strategy. Okay. Just the same way, Rick, that you would set any alert. Place a price alert across your chart. I want to be alerted when the price crosses up through that Heikin-Ashi candle. That's simple. Boom, it's done. Okay. That's all you have to do. Place that price alert, wait for the trade. All right. Then we're going to follow this along in the same manner. So we have our entry price that we're entering into that trade. We have our exit price where we're going to stop out of this trade. What's the next step? We have to know what our trade goal is. You know, I've been working this over and over and over with the members of Right Way Options here lately. How many here from Right Way Options are willing to say that having that calculation, knowing a trade goal and exiting the trade once you've reached your trade goal is actually making for good trading? You're making money that way. You're not allowing greed to get in the way of the trade. So you need to have some kind of goal. What are you reaching for in this trade? Now, you don't want to be, silly, ridiculous, or anything like that. If you're trading this as a stock trade, it may be 5%. If you're trading this as an option trade, your goals may be 15, 20%. Okay. And then you start figuring out how you're going to close those trades. So say, for example, you buy this as an option position and you're looking for a 20% gain. You've got 3 contracts in this position. And you get that 20% gain comes in. We hit it right here. Boom. You need to be taking some profits. Okay? You cannot lose money in the market if you get comfortable taking profits. If you continuously always try to squeeze a trade, I just want more money, more money, more money out of every trade. How many of you will admit you've had good money in trades, nice profits in trades, and turned them into losers? Wanting more money. Remember, what we have to do is we have to be conscious of the idea that our job is to make money, not to get rich quick. Our job is to make consistent money. So we have to put in those plans. This is what we want to do. Now, if I had a 3 contract trade on here, this is exactly how I would trade this. I get my goal up here around 20%. I would close 2 contracts. And then I just start, after the end of every one of these candles gets formed, I would place my stop loss. I adjust my stop loss, adjust my stop loss, adjust my stop loss, adjust my stop loss, until I've either reached a point where I'm getting nervous because I've got so much money in the trade, or the stock reverses and stops me out. Okay? Now, one thing that's really important to remember is the reason we're thinking about doing this is because of the smoothness of the Heikin-Ashi candle. You know, one of the best purposes for Heikin-Ashi is to help you avoid the micromanagement of the trade. To allow the trade to develop, to allow the trade to work. To avoid that micromanagement that we tend to do because we get nervous on these daily whips and stuff that happens in these stocks. Heikin-Ashi smooths that out, cleans up that chart for those potential trades. Now, this works up candles, down candles, it really doesn't matter. Take a stock like Roku. Could you imagine getting short this trade here? Failing underneath here, getting short that trade. Stock goes from 140 down to 105, a 40-point loss. And all you have to do is follow that trade down, taking profits along the way. Same thing is true on the upside. Imagine this move where we get this crossover here, this nice little pullback in here, set a price alert in this trade, enter that position, and look at these candles. Just easy to follow this trend up, all the way up. Locking in profits as you go. Okay. Remember, trader, the wicks and tails in a Heikin-Ashi candle are different. Okay? When we are in a strong uptrend, there are no tails on the candles. When we are in a strong down, there are no wicks on the candles. It's only when we hit these transition points that we actually have wicks and tails coming into play. Okay. So just follow the candles. Don't overthink this, guys. This is actually very simple. If you want to trade this on a shorter term time frame, look at it on a 4-hour. Could you make money following this down? Do you have to micromanage this on the way down? I mean, seriously. And does it matter if you enter this trade and it's 25 cents difference than what the live price is when you take a trade like this to the downside? Does it matter? No, you're making big bucks. Okay. Big bucks. So remember, the Heikin-Ashi candle, this candle is forming. It's also calculating from this candle. So what happened in Roku here at the end of the day? Well, if we look at a regular price chart of 4 hours, you're going to see what happened here. The stock made that reversal. Okay, these two candles right here were averaged together. These two last periods were averaged together. We end up with a candle that looks like this, a transition candle. Okay, so pick your time frame. Pick the time frame you want to trade, and then set up your strategy how you're going to follow this. Can you guys see yourself? Is anyone in here seeing themselves as being able to see this breakdown very easily, entering that trade and following that trade down? This is in 1 hour on Roku. Do you even see that as possible? How simple it is to see the patterns themselves and utilize them to your favor? Here's an hourly upside. Okay. So we're going to first identify a trend. If we're looking for an up move, we're looking for that 6 exponential moving average being crossed over by the 3, by the 2, the 2 pulling back to hold as support. We don't want to see it cross back down and a cross back up. What is this? Chop. Right here, chop. Up and down. We don't want to get caught in chop. We want to find that failure, that rally back to resistance that shows continued failure. By the way, this happened pretty simply. It's very simple to follow that trade. Okay, so we want that cross up, that proof that it's going to hold, and then we wait for that entry candle to the upside. Okay, if we're looking for that down move, we're going to wait. We want that cross down, that push up or consolidation, and then that failure candle that shows continued pressure to the downside. And then we follow those trades down without a whole lot of micromanagement. I mean, how hard is it to every hour look at your chart and adjust your stop loss? Pretty darn simple, isn't it? How hard is it to see these beautiful consolidations? Heikin-Ashi consolidations are stellar because of that averaging effect. Not only support and resistance, it's easy to see trend, isn't it, Frank? Now, the only reason I've got that 17 in there is to help us see trend. When price is above the 17 and we continue to move up, that 17 is showing us trend. Showing us that we're on the right side of the trade. Should we be considering any long trade if the price is below the 17? No. Yeah, we shouldn't be. Should we be considering any long trade if the price is below the 17? No. Those are our failures. So we've got an entire concise package here that sets up with this Heikin-Ashi in any conceivable time frame that you want to trade with a very simple set of rules. Entry into the trade, we're patient and wait for those trades. I mean, look at this. This is hours. How many hours did this go sideways? Right here, setting this up. Is it really hard to see that? And is it terribly hard to place an alert right here and say, when it crosses down through there, let me know? Pretty simple, right? We just have to identify the trend, identify the potential that this is just consolidating or rallying back up toward its resistance point, and we wait for the failure pattern to occur. Don't predict it. Wait for it to happen. And then follow that trade. Okay? On any time frame, on any stock. So it's a very simple strategy with a set of rules that keeps you on the right side of the trade. We know by looking at this chart when the stock is bullish and when it's bearish. We know by looking at this chart, we can see very clearly, just by the color of the candles, that we've switched over from a bull run to a bear run, and we can look real quickly and say, is this a strong bear run? Because these have no wicks on these candles. Is this a strong bull run? Because there are no tails on these candles. Okay. With a Heikin-Ashi, Rick, we'll just look at the price action. Where would you rather enter? Would you rather enter when it crosses down through here, or wait until it's already moved down when your stop loss is here? Because of the averaging effect on these candles, you want to take the signal when it occurs. Okay, because if you wait for another period, remember, you're trading an hourly chart, that's a 2-hour wait on that trade. By that time down here, all you've done is increase your risk to your stop loss. by doing that. So remember, these are averaged candles. We want to enter those when those occur. We don't want to be waiting. We don't want to be micromanaging those entries. Now, when should we not take the trade? The question I think you're asking is, when should I not take the trade? Okay. Well, when should we not take the trade on this? 8 crosses back above the 17 and then starts to pull back. That's not our setup, right? We want the 8 staying below the 17, the 3 staying below the 8, and we're waiting for that cross down, that failure point. Heikin-Ashi will disguise, yes, Heikin-Ashi will disguise gaps. Okay. But if you go back, and here's the thing I would ask you about this. No, I mean the 6 and the 2. 6 exponential, 2 exponential, and a 17 exponential. Yeah, sorry, 6 and a 2. Apologize. Okay. Yes, right now you have wicks and tails. What is this? This is a transition. There's no trade here. There's no failure point. There's no rally point. Now we're staying below the 17. If we think this is going to move on down, wouldn't we want to place a price alert here and wait for that candle? If it forms like this, great. We take that trade south. We just follow our trend. It just keeps going down. Let's follow it down. Okay? And here's the other thing. If you place that alert and wait for that trade, we're not going to micromanage this. We're not going to anticipate this. If the stock happens to go up from here, who cares? That's not the trade we were looking for. Now we have to wait for the crossover and the pullback. Right? We have to take that transition down to a transition up and wait for the next entry into the trade. It's not chasing these moves. It's here. Now, the question was about disguising gaps. If you look at Roku here, what you're going to find is this was a big gap right in here. That's one of the reasons why we don't want to chase the crossover. We want to wait for those entries in concise price action. Okay, wait for that concise price action. Don't be chasing trades. Don't get into that whole thing, oh my gosh, I'm missing out. Because we know when a stock gaps or moves up sharply, it's almost always going to relax and pull back. And we're waiting for these comfortable entries in here. Those are our winning trades. Those are our easy to win trades. Okay. Terry, no. If you're going to follow the Heikin-Ashi, if you're going to manage by the Heikin-Ashi, manage by the Heikin-Ashi. Don't jump back and forth between standard candlesticks and these candlesticks. Is it hard to see where the stop losses should be in this run? Is it difficult? If price breaks down below these levels, do we want to be in this trade? If we entered this position on this breakout here, we enter this trade and we place our stop loss right underneath this level, did we get hurt on that position? No. Follow it here. Did we get hurt on that position? No. Did we get hurt on this position? No. Don't overthink this. What you have to do is get comfortable with looking at these candles and just managing the trades based on what you see. If you always are jumping back and forth, it's going to make you crazy.